Welcome to the InterMarket Analysis video update. This is a video that I do once a week where I look outside of the S&P 500. We look at other indexes, we look at other sectors, we look at other markets to see if we can get some insight or gain some clues as to what will ultimately happen within the S&P 500. We also look at earnings going forward and going backward. We compare things with each other and just see what we can come up with to give us some insight that we may not have had before. This is being prepared for Monday, July 31st. The first area that we look at is valuation. First, we look back and see what have companies already reported in the S&P, and then we look forward to see are we overvalued, undervalued, or priced just about right. The first area looks back, and this is called TTM, or the trailing 12 months. We compare that with a thing called the PE ratio, or price to earnings ratio. When the price to earnings ratio gets very high, that means a stock or an index is overvalued. When it gets very low, that could mean that it's undervalued. Well, the market over the years has come up with some static numbers, such as 20 or above to be expensive. If we're between 11 and 19, that's about fairly priced. If we drop to 10 or below, that's considered to be inexpensive. If we look at this chart, we see the black line, which is the S&P 500, is above the red line. That's the PE ratio of 20. So, on a historical basis, the S&P 500 is considered to be expensive. Down on the bottom, I have the spread between the red line and the current value of the S&P, and as the S&P has been going up, this line has also been going up. We can also look at that historically to see different events that have happened in the past and what were the valuations at that time. Sometimes we were overvalued before this event happened, sometimes undervalued, sometimes we were fairly priced. We also look at a thing called the Shiller PE ratio, developed by Robert Shiller. This takes more of an average over a longer period of time to try to determine if we're overvalued, undervalued, or just about right. Currently, the reading on this ratio is 31.94. To give us some context, we look at the median and the mean. Looking at these levels, we're between 16 and 17. The S&P would be considered to be twice as expensive as it should be on a historical basis. You can also see on this chart, going way back to the 1800s, different events that have happened and what the valuations were at that time. Just a point of note, we're at 31.94 now. On Black Tuesday, back in 1929, we were actually below the current valuations that we're at now. And I don't say this to scare you or anything else. We use technical analysis to try to determine if we're going up, down, or sideways. These are just things that we want to keep in mind, and the market usually doesn't make short-term decisions based on valuation. It uses them based on charts, based on emotion, and other things. This is just something that we want to know and keep track of. Then we look forward. We look at the S&P 500. Remember that 10, 15, 20 scale? Well, right now, on a forward-looking basis, the S&P 500 is at 19.7, so it's just below that 20 level. We look at the mid-caps. They're at 14.4. They're just under the 15 level, and the small caps are also under 15 at 14.2. Then we look at growth versus value. Growth are the stocks that you want to buy low and sell high. They're really good when we're in a bull market and going higher. Value stocks tend to weather the storm better. They're usually companies that have been around for a long time. They may pay dividends. They may have stood the test of time. And so folks tend to gravitate over to these kinds of stocks when the market's running into some trouble. What's interesting is we can compare growth to value. When we're in a growth environment, we expect the indexes to go up. When we're in a value environment, that's usually when we're running into trouble. So first we look at a pure growth index, which is still in a downtrend, but it is showing some improvement ever since the beginning of July. We also look at a pure value index, which is also in a downtrend and has been bouncing back slightly. The interesting thing is when we compare the two. On top, we have growth to value, where growth is outperforming value on the top. Then we do another calculation, which is an inverse chart, where value is underperforming growth on the bottom. The reason why I do a lot of double charts and I look at the inverse of that same chart, these are often calculated in a slightly different way. You can see there's a slight deviation here. Not a big deal, but if you're trying to make a decision, you want to have the best information available. We also look at the pure growth index that we just looked at and compare it with the pure value index, and it's going down overall, but growth is outperforming value. Then we look at an inverse of that same chart, a little less of a time frame, where we show where value is underperforming growth. We also look at some ETFs, showing that growth is outperforming value. And then we look at value underperforming growth. Then the last chart, we look at a growth index and compare it with a value index, showing that growth is outperforming value. We also look at the small caps, where they continue to be in an uptrend overall, but since about the middle of March or so, we've been chopping more or less sideways. We want to see this really going up in a good, healthy environment. Where we have seen a little more strength is in the mid-cap growth when we compare it to mid-cap value. This is in more of a stronger uptrend and has seen a little bit of a recovery after it got hit earlier this week. We look at growth of value with some other ratios showing that growth is improving. It's coming above this rainbow chart. We did get hit earlier in the week, but now we're trying to come back, so it is improving. We look at an inverse of that, showing how value has been underperforming growth. Then we look at S&P growth to value. This affects the S&P 500. We are in an uptrend, but it's been a little discouraging because we're trailing off here and we're seeing some more shorter term weakness. So we want to see this really going up if you're more positive on the market. We also keep an eye on inflation. This is a monthly chart of the CRB where it's in a downtrend, but it's starting to come back above the moving average. We also compare that with an inflation-deflation ratio where it's coming back up just a little bit. It's above the moving average, but overall the moving average is pretty much flat. We keep an eye on the CRB index. These are commodities where it's in a downtrend, but it has been bouncing back lately. We also look at the Baltic Dry Index. What does it cost to ship products from one place to another? This is in an overall downtrend. In a more inflationary environment, we would see this going up. Some other markets that we keep an eye on. Aluminum, showing that we're in a downtrend. Corn is also in a downtrend. Wheat continues to be in a downtrend. We check on fertilizer. It's ticking back up, but is still in a downtrend. Oil is starting to bounce back up. It's still in a downtrend, but it was at 70 for quite a while. Now it's getting up to 80. Where we look at gas, where it's just starting to go into a positive uptrend. It's really hard to see, but the blue moving average is a little bit above the red moving average. In a downtrend, we would see the reverse of that. Natural gas, after spiking up and coming down, has been bouncing back up, but still is in a downtrend. Heating oil, also spiking up again a little bit here, but still in a downtrend. We keep an eye on diesel prices. Also, they've been really falling off and seeing a little bit of a bounce lately. Copper is another thing that we keep an eye on. We call it Dr. Copper. If copper's going up, that generally means the economy is looking better. And we're just crossing over for a death cross now with copper on the daily chart, and we're very close to that on the weekly chart. We also look at the copper to gold ratio. When copper's going up, gold is typically going down and the economy's doing better. When copper's going down and gold is going up, typically the economy's doing worse. We are in a downtrend with the copper to gold ratio, even though it has been able to come back above this moving average and has seen some recent weakness. We look at a longer term version of that, and we also plot a 2-year and 10-year yield. The black line is the copper to gold ratio. The green line is the 2-year yield, and the red line is the 10-year yield. And typically these don't get all that far apart from each other. You can see other times looking back where they tend to stay pretty close, even though they're on different scales. We're still seeing quite a wide spread between these. We look at gold, which is still in an uptrend. It came down to its 50-period moving average and so far has been holding up above that. We keep an eye on silver, also above its 50-period moving average and in an uptrend. Then we look at gold all by itself and silver all by itself, just so that we can qualify that yes, they do have a tendency to go in the same direction. That's what the correlation shows on the bottom. We also have a study here. The gold to silver ratio is on top. Which one's outperforming? When this one's going up, gold is outperforming. When it's going down, silver is outperforming. Then below that, we look at the US dollar index, and a general observation is when the dollar index goes up, gold outperforms silver. When the US dollar index goes down, silver outperforms gold. Now they both can be going up, is what is outperforming the other one. And then at the very bottom, we show the correlation, and it's pretty strong between this ratio and the US dollar index. So we just want to keep an eye on this. We look at the dollar index, which saw some weakness, but this past week was able to get back above 100. We compare that to the euro, which is in an uptrend compared to the dollar, but did come down on Friday. We also compare this to the Japanese yen, and I have a standalone chart because there's interesting things happening in Japan. Here is the Japanese yen. It's still in a downtrend. It's been chopping around. We'll have to see if the yen can pick up some strength against the dollar. Typically, the market's like a weaker US dollar because that makes their books look better because of conversion. And also, it works more in the favor of US companies for imports and exports. Then we look at the British pound to the US dollar, and the pound is outperforming the dollar. We look at some index ratios. This is the S&P 500 to the CRB index, where the S&P is outperforming. We look at an inverse of that same chart showing how the CRB index is underperforming. We compare the NASDAQ 100, which has been doing really well, and the S&P 500, which has been doing really well, but the NASDAQ 100 is outperforming the S&P 500. We look at the S&P 100, the biggest stocks in the S&P 500. They're turning back up after we saw a death cross in this ratio, but they could be showing some improvement. We're also keeping an eye on the equal weight index. The S&P 500 itself is a weighted index, so the big companies have more of an influence. In the equal weight index, all the companies are treated the same. When the equal weight index is going above the S&P 500 index, that's usually stronger. That means there's broader participation in the market. It had been underperforming for quite a while, but we're starting to see this show some improvement. We compare small caps with the S&P 500. In a good, solid environment, we want to see small caps doing well. That's not what's happening now. The small caps continue to underperform the S&P 500. The NASDAQ has been outperforming the S&P 500. Both have been doing well, but the NASDAQ has been doing even better. We look at the NASDAQ 100, which has been doing really well, and the NASDAQ, and compare that. The NASDAQ 100 is outperforming the rest of the NASDAQ. We compare the S&P 500 with other stocks. First, we look at an advanced decline line studies. I show this in the daily videos. We just want to keep an eye on what's happening in different indexes. Right now, the NYSE, S&P, mid caps, and small caps are showing improvement, and they're above their moving averages on their advanced decline lines. We keep an eye on the 30 biggest software companies, which continue to be in an uptrend. The mega cap growth stocks, these are the real big ones. Apple, Google, Microsoft. They are really outperforming and in a solid uptrend. We look at robotics and AI. That's kind of the new craze right now. It's in an overall uptrend. But when you compare it to the tech sector, it's actually starting to underperform and rolling over a little bit. We look at the S&P 500 and compare it to shorter-term bonds, suggesting that stocks are outperforming bonds. Then we look at a broad market measure, taking more stocks and looking further out with bonds. This is also suggesting that stocks are outperforming bonds. This is suggesting more participation by stocks outside of the S&P. We look at the tech sector and compare it with bonds, and tech is really outperforming. Then we look at the Dow Jones Composite Average. This is the Dow, the transports, and the utilities together. They've been chopping sideways for quite a while, even though they were in an uptrend. Now it does look like they could be breaking out to the upside. This could be positive for the overall market. We look at low volatility stocks, which held up a lot better in 2022. They're still holding up in 2023, but they're not seeing the massive gains that we're seeing in the growth stocks. We compare the low volatility stocks with the S&P, and the low volatility stocks are really underperforming. We look at Dow theory. Sometimes I pay a lot of attention to this, other times I really don't. Lately I have been. We're breaking out here on the Dow, and we're seeing that confirmed by the transports. We've been keeping an eye on the transports. If the transports are looking better, the U.S. economy typically is looking better. And when the utilities are underperforming, that also can help the S&P 500. In fact, on this next chart, we have a ratio between the transports and the S&P 500, showing that this ratio is going up. In a good, solid environment, that's what we want to see. If we start to see some weakness, this ratio would then begin to come down. Looking at the FANG index, the really big companies, Facebook or Meta, Amazon, Apple, Netflix, Google, and there's some other ones thrown in the mix, they are also in an overall uptrend. And then I take a longer term look at the FANG index where we came back and set an all-time high, but then we dropped down below that. We're trying to come back up to the previous all-time high. Will this act as overhead resistance? Will we be able to break through that, or are we going to come back down below that? Keep an eye on ARK. I know a lot of folks get into that. It's finally in an uptrend and showing some improvement. It was up almost 5.5% on the week. A new take on Dow theory. The traditional Dow theory uses the Dow and the transports. A new way of looking at this is, instead of using the Dow, that's 30 stocks, we look at the S&P 500, which is more of a representation of the U.S. economy. And then instead of looking at transports, which used to mean railroad stocks, we look at the NASDAQ, which is highly made up of tech stocks. That's more indicative of what the U.S. economy is like now. Right now, it's just suggesting that these are confirming each other. We're seeing the S&P breaking out, and we're also seeing the NASDAQ breaking out. So they're both looking quite positive. We typically look for some kind of divergences in here, but right now they're confirming each other. We look at the S&P 500 on a monthly chart, and then compare it with Europe, Australia, Asia, and the Far East. We're above this moving average, and we're going higher. That's suggesting an uptrend. and we have a momentum oscillator, the PPO, which is turned up and continues to go higher. It would be even more positive if it could get above 0. We also look internationally. What's China doing right now? It's starting to go back up. We're also seeing a turn back up in emerging markets. Europe is trying to go back up. Japan is going back up. And the US is starting to go back up. So we're seeing this across the whole globe currently. We look at bonds versus stocks. I show this in the daily video. This is a price chart of the 7 to 10 year bond ETF. We saw some weakness this past week. When bonds go down, interest rates go up. We're dropping below the 200-day moving average. The RSI is below 50, but it is starting to go back up. The MACD on the bottom is showing that the momentum is switching over to negative. We look at the total bond ETF, where it's been chopping sideways, but is still in an uptrend. The Pring World Bond Index, not just U.S. bonds, but outside of the U.S., it's been really choppy lately, but still is in somewhat of an uptrend. We compare stocks to bonds on a monthly chart, showing how stocks are outperforming. And we look at riskier bonds, which you might call junk bonds, and more conservative bonds, which you might call government bonds. Folks are liking the fact that they can get into riskier bonds and get a better return. That's what happens when this ratio is going up. And we also see on this chart where bonds continue to underperform stocks. High yield corporate bonds, this means junk bonds, they continue to be in an uptrend. And investment grade bonds don't give you as high a return, but are usually safer. They're chopping sideways, but continue to be in an uptrend. We look at the stock to bond correlation. It's pretty much neutral right now. When we're above this blue line, we're going in the same direction. When we drop below this red line, we're going in opposite directions, and we're right about at 0 now, so it's neutral. We look at the Dow Jones Corporate Bond Index, not as much of a popular market. It's been going sideways, but still is in an uptrend. We'll have to see if this is able to break out, or are we going to see some weakness. We look at the 10-year yield, and we're above all the Fibonacci retracement levels currently. If we really start to move around, I'll draw another Fibonacci chart on here. We look at the 10-year Treasury yield, where for 40 years we saw a series of lower highs and lower lows when it came to interest rates. We're starting to go back up now. Are we seeing a shift to a higher interest rate environment? Chris Javaco from Javaco Capital, who puts out a very good weekly video on YouTube, he's really more focused on this, keeping an eye on things, and that's where I got this idea. The 30-year yield is still above the 61.8% retracement level. And then we look at the S&P and compare it to the yield of the 10-year, where the S&P is outperforming the rise in interest rates. Junk bonds continue to be in an uptrend. When we compare junk bonds to government bonds, junk bonds are outperforming. This is a daily chart of yields and how they change every day. They did start to go up this past week, but they came down a bit on Friday. Then we look at a weekly chart looking at the US, UK, Japan, and Germany. The UK currently has the highest interest rates, followed by the US, and then the blue line is Germany. We're watching Japan, that's the red line, because there was some news coming out of the Bank of Japan this past week. They're going to start a program where they're going to keep their rates at 0.5%. And then they're going to buy Japanese bonds at the full price, hoping that that will stimulate things. The reason why we're keeping an eye on this is Japan owns an awful lot of U.S. Treasury bonds. If things go bad in Japan, they're going to have to start selling those. If they sell those, that's going to push bond prices down and interest rates up. That could feed over into the U.S. bond market as well as into the stock market. We're looking at the 5-year yield study. We're above the moving average, so the 5-year yield continues to go higher. This is a weekly chart. On a short-term basis, we're almost crossing over negative. We're pretty much flat to slightly positive in the intermediate term, and we continue to head lower in the longer term. Another 5-year study using a daily chart where we're still above the moving average. The Special K, which is a long-term momentum oscillator, it's still in a downtrend, and the KST is also headed lower. We look at a long-term bond ETF. Now this is based on price. In the short term we're positive. We're still negative in the intermediate term, but we continue to be positive in the long term. Then we look at the MOVE Index. This measures the volatility of bonds, where even though bonds moved quite a bit this past week, it really didn't move in their index. We compare that to the VIX, which measures volatility in stocks, and we see that the correlation between the two is pretty much neutral right now. Then we look at the S&P with other sectors. We look at the material sectors, which is still in a downtrend compared to the S&P. Communication is in an uptrend and has been doing quite well. The energy sector is in a downtrend when compared to the S&P. The financials also in a downtrend. Industrials in a downtrend, but showing some improvement. Tech is in an uptrend compared to the S&P. Staples are in a downtrend. Real estate continues to be in a pretty significant downtrend. The utilities are also in a downtrend. And then we look at the S&P to utilities ratio. When this is going up, that often gives good support to the S&P. When it turns and starts to come down, often that will mark a top in the S&P. And as we're going down, that will add more weakness to the S&P. Then we look at healthcare, which is also in a downtrend. Here's another chart of healthcare showing that we're in a downtrend. Then we look at discretionary. The things that make life fun, they're starting to perform better. And we've seen a recent golden cross with this ratio. The staples sector, the things that you have to have no matter what's going on in the economy, they're still in an uptrend. And the tech sector is also in an uptrend. The SOX index, which measures semiconductors, they're in an uptrend. The tech sector compared to the S&P shows that tech is outperforming. When we look at growth stocks and compare them to government bonds, growth stocks are really starting to outperform. When we compare the energy sector with the tech sector, energy did great in 2022, but now it's underperforming in 2023, showing that the tech sector is outperforming. We also look at the tech sector with the rise in interest rates, where tech is outperforming interest rates. Then here's an inverse of that same chart showing how interest rates are underperforming the tech sector. Discretionary versus staples. We keep a close eye on this. Discretionary is outperforming staples. And that's more indicative of a growth environment for the stock market. Then staples are underperforming the discretionary sector. We compare gold with the S&P, where it's really starting to underperform, and we're seeing a recent death cross with this ratio. We also compare gold to the dollar. It's having a real hard time breaking through this resistance and showing some weakness, even though gold is still in an uptrend. High leverage loans. These are risky loans, and if the economy was getting ready to fall off a cliff, do you think it would be going up the way it is? Probably not. The NYSE composite is also in an uptrend, and then we compare small caps to the S&P 500 again. The red line is the ratio between the two, and in a good solid environment, we want to see this red line going up. The blue line is the S&P 500 for comparison. All stocks, not only in the US, but outside of the US, these still continue to be in an uptrend. Emerging markets also in an uptrend. Bitcoin had a little bit of trouble this past week, but is still hanging around that 30,000 level. And then we look at an intermarket analysis chart going back to the beginning of the year. Stocks have been doing the best, followed by gold, and then bonds, and now oil is starting to creep in there. And then we have the dollar. So everything is up if you go back to the beginning of 2023. We look at some correlations. We compare the S&P to the dollar. They're having a slight tendency to go in the same direction, but almost neutral. When we look at the S&P and oil, they're having more of a tendency to go in the same direction. The S&P 500 to the 10-year yield, it is now neutral. And the tech sector to the 10-year, they're having a tendency to go in opposite directions. We compare the S&P 500 to the 2-year yield, it's dropping down into this neutral area. Then just to keep an eye on things, these are the home builders. We have the S&P on top, then the home builders ETF. We have a ratio between the two, it's going up, and we're seeing that there's a really strong correlation between the two. We look for negative divergences or convergences here. Right now, I would say they're converging, but when one really starts to go down and the other one's going up or vice versa, that's when we really take notice of things on this chart, and we're really not seeing anything right now. We look at some long-term secular, which can mean decades, as well as cyclical, which can mean years, trend studies. We look at the NYSE composite on top, and this is a monthly chart. We're above the moving average, so that's suggesting that we're positive. And the Coppet curve down below is also turning and going back up. That's also positive. We look at the NYSE on a daily chart, and then we look at the record high percent index, and it is continuing to advance. That's also positive. Then we look at the S&P on a monthly scale. We're above the moving average, and the PPO, which is a momentum oscillator, continues to advance. Then we compare the S&P 500 with the CRB index and then take a ratio. It shows that the S&P is outperforming the CRB index. Then we look at the S&P and compare it with a global index on a monthly chart. We're above the moving average and advancing, but the KST continues to be negative. It can take a long time for these charts to change. Then at the end of this video, I go through a list of what is positive and what is negative. My definition of positive is when the 50-day moving average is above the 200-day moving average. We have the big software companies, the euro and British pound against the dollar, gold and silver, the mega caps, the low volatility ETF, the Dow Jones Composite Average, FANG Index as well as ARC, Bonds, all the different bonds that we look at continue to be positive. Staples, tech, and the semiconductors, the high leverage loans, the Dow, the mid caps, and now the small caps. And we're seeing confirmation from that. We're seeing it on the Russell 2000 and the S&P small cap index. The NASDAQ and NASDAQ 100, the NYSE composite, all stocks, emerging markets, and then Bitcoin is still positive even though it's run into some recent trouble. What's negative? That's when the 50-period moving average drops below the 200-period moving average. The growth indexes and ETFs as well as the value indexes. In and of themselves, they're both in downtrends, but when we compare them, growth is outperforming value. The CRB index, even though it had a good week, is still in a downtrend. Copper is now in a downtrend. The dollar is in a downtrend. The Japanese yen to the US dollar is also in a downtrend. And then we have microcaps. They came back and set a new 52-week low not so long ago. They're doing better now, but we're just keeping an eye on those. Thank you. I hope you found this helpful. Please feel free to check out some of the other videos that I post. Have a great weekend, and I will talk to you in the next video.